Hey, Hallie, how do I? Okay, so I turn this on and it's recording. Actually, I gotta turn the recorder on.
Okay. Did you copy a URL?
Yeah, I did that already.
Okay. Why are you recording? Stop recording. Would you like to cancel?
No.
Cancel?
No, I want to record later when I'm talking. That's
Yeah. Okay.
It
Then
stopped. There we go. All right, we're recording because it looks like a lot of people are going to watch this after the event. We have 61 people, but perhaps we just have a few latecomers. So anyway, I thought the way we would do this tonight was we would start with reviewing the first half of chapter 7. Excuse me. And then we would go on and do UDIPTA. And I don't think we'll finish that tonight, but we'll see how far we get. So, and for those of you who did the package or did this assignment, you will see these questions look very familiar, and here, in fact, will be, excuse me, the official answers to the, although I was hoping that everyone would do a more deeper, more enhanced answer, but we'll answer them sufficiently so that you get the picture of what's going on in this. So if you have the package in front of you, it's the Chapter 7 review outline. I think we have like about 75 questions, and we'll start with number 1 because that seems like a good place to start. We'll work our way through it, and then halfway through we'll talk a little bit about UDIPTA, and then we'll do those questions as well, because that's sort of a statute that's just best exemplified. Why talk about it when we can actually work our way through some questions? So question number 1, and I hope you have this in front of you, and I will give you I will send you the version with the answers at some point. So Consolidated Lint Inc. is organized in Delaware with headquarters in New York. The company had federal taxable income of $600,000 in 2020 after deducting $100,000 of New York taxes. In 2019, Consolidated Lint Inc. sold $100,000 of lint to New York customers and shipped $3 million to customers all around the world. New York has a single sales factor apportionment. New York has rolling conformity with the Internal Revenue Code. So our very first question, 1A, is what is New York entire net income? Well, because New York has rolling conformity with the Internal Revenue Code, our starting point is going to be the $600,000 of federal taxable income. But of course, do we stop there? No, right? We have to add in modifications. Now, and there's about 30 different modifications. Some increase state taxable income, some decrease, but this is just an example of one of them. Typically, the states don't allow you a deduction for federal taxes or for state taxes or for foreign taxes. So here, the fact that in arriving at federal taxable income, you deducted $100,000, that has to be added back. So our New York taxable income, or what New York likes to call it, New York entire net income, is $700,000. Okay, so the 600,000 plus the 100,000. Okay. Then part B, what is our apportionment percentage? Well, we'll know more about that later tonight, but just take it on faith for now. In New York, if it's a sales factor, it's New York sales divided by total sales. And so our apportionment, 100 divided by 3 million, is 3.3333%. Okay, so that's the answer to B, is 3.33%. And then part C, what is New York's apportioned entire net income? And that would be 700,000, our total New York entire net income, times the apportionment, equals, hope I got this right, $23,310. So that's 700,000 times 3.33% is $23,310. Then, even though this is really sort of beyond where we really go in the course, then of course the next step is to apply the tax rate. So, and I just made up this number. New York's tax rate is 10%. It's really not that high. It's 6.5%. But just to make it easy, we'll assume it's 10%, and that would be 23,310 times 10%, and that's our answer to D. $2,331 is our tax. With me, everybody? Okay, I'll continue. Oh, we're up to 80 people. Cool. All right, Part E. If instead of rolling conformity, New York defined, federal taxable income as that amount that would have been computed using the Internal Revenue Code that was in place on August 18th, 2003, how would this affect the computation? And well, we would have to recompute federal taxable income, finding an old Internal Revenue Code and figuring out what the taxable income would have been with the law that was in place back in 2003. I can tell you one thing: it wouldn't include bonus depreciation, among other things. And so we would recalculate federal taxable income using the old law, and then we would make our modification of adding back the $100,000 of state taxes. Okay, with me? All right, so that was the rolling. That was the whole business at the start of the chapter on rolling conformity, and I dare say there will be a question on this on the final. Okay, so number 2. In 2020, Consolidated Lint Inc. became concerned about an increasingly competitive market for lint. Seeking to diversify and increase corporate earnings, the company started to invest and build new jet engines for the Air Force at a new location in California. In 2020, the Lint division had a good year, earning $4 million in federal taxable income, while the new jet engines division lost $500,000 in federal taxable income. In New York, the Lint division had apportionment of 40%, and the jet engines division had apportionment of 10%. Collectively, the two divisions had New York apportionment of 35%. So, in your opinion, are these two businesses unitary? Well, it's kind of hard to ask without more facts, but I guess on the surface, there probably isn't a whole lot of value between a lint business and a jet engine business. They probably don't enjoy the same technologies, such that I'm sorry, I'm getting a message. Okay, I'm going to disregard that message. Okay, so it's not terribly likely that these two businesses are unitary, right? They're completely different businesses, so it's unlikely. Although I will admit that there are probably some other factors that we would probably want to rule out too. All right, Part B. What tax would Consolidated Lint Inc. own New York if the two divisions are treated as separate unitary businesses? Well, in that case, and you're probably not going to be able to copy down this computation as quickly as I'm going to rattle it off, but it would be, first we would have to consider the division separately. So Lint would be 4 million times 40% equals 1.6 million times the 10% tax rate equals tax of $160,000. While the jet engine division lost 500,000, which we would apportion separately at 10%, equals a $50,000 loss times the 10% tax rate equals a $5,000 loss, net operating loss. And if we add those two together, we would have 160,000 less 5,000 equals $155,000. And that would be if we filed as a non-unitary basis. So essentially, even though it would be on the same return, we would show that we would actually do two sets of calculations, and we would end up with $155,000 of tax. Now, on the other hand, if we could somehow argue that this was a single unitary business, we would commingle the income, right? So Lint made 4 million while Jet lost 500,000, so that would be 3.5 million. The apportionment would now be sort of mushed together. The apportionment would be 35%, and then the tax rate is 10%, and we would end up with tax of only $122,500. So if you had your druthers, you would like to file on a unitary basis. Now, I probably should have worked this into the questions here, but let me just mention something sort of, I guess maybe not part of the course, but just worth mentioning. In New York, you would actually get your wish. You would get to, there is an election that you can make on the New York return to sort of combine non-unitary companies and treat them as a single filing unit. It's called what is it? The controlled corporation election. So corporations that are under the same ownership can mush things together. Now, of course, you're completely violating the unitary concept here. So how does New York get away with that? And it's because it's voluntary. They're not holding a gun to your head and saying, hey, you have to do it this way. They're just allowing it as an option. And because it's voluntary and taxpayers just enter into it of their own volition, they get to treat non-unitary companies on a consolidated basis. And New York has that law, and New Jersey just recently adopted that law. Now, you don't do this. You take a little bit of a chance when you do something like this because the state is smart. They're saying they don't want people electing in and out of this on a year-by-year basis. So New York makes you make this election on a 6-year basis, while New Jersey, it's a 7-year election. And they make it quite clear that you make this election, there's no way out. So you're stuck with it. So just thought I would throw that in. That's a voluntary type choice that's available in just a couple of states. Okay, part D. Say that in California, the jet engines division had apportionment of 100% and the lint division had apportionment of 0%. Well, what is the optimal filing position? One or two unitary businesses? Well, in California, the taxpayer would want to file as a separate non-unitary business and report only the $500,000 loss and receive a net operating loss of $500,000. So clearly, because the other company isn't even operating, isn't in California. So clear? Make sense? Okie doke. Okay, let's do question 3. Say that Consolidated Lint Inc. decided that instead of diversifying into jet engines, it decided to stick with what it knew and developed a line of stuffed animals which it sold to stores. 70% of the company's lint production was utilized by the toy division to fill in the stuffed animals. It is likely or not likely that these divisions constitute a single unitary business. I would like a volunteer. What is this? Somebody speak. I'm looking at my list of people here. Annie Kung, you're here. I see you listed. What do you think? Is this a unitary business?
Yes.
Hi. Oh,
Yeah, and what's the defining feature of it?
it's a vertically integrated business.
Absolutely.
So it's unitary.
Yeah, it's right. One division is selling all of its or 70% of its production to the other one. So yeah, it's like it's certainly vertically integrated. I would take that case on contingency because that's a case you're going to win. Okay, part 4. In 2019, the Treasury Unit of Consolidated Lint, located at its company headquarters at 40 Wall Street, purchased 1% of the outstanding stock of Augo Inc., a gold mining company listed on the New York Stock Exchange. In 2020, the stock is sold for a $100,000 profit. Can Connecticut, assuming Consolidated Lint has lint business nexus in Connecticut, tax the gain on the stock? Volunteer? Do I have to call on somebody? Come on, it'll be fun. Just Becky, you want to join in? I guess not. Krista? Oh no, wait, I'm sorry. Who is? There's someone. Just Andy. Andy, don't know who you are, but Andy, want to try this one?
Yeah, sure. It's number 4, right?
Yes.
Are we doing a part A?
Well, there really is no, oh, yes, I guess, uh, no, well, we're doing before part A, okay? So there's a question there. So what am I asking here? And
Yeah.
we have to move quickly, I'm gonna let you off the hook, okay? So basically, it's a bit of a trick question here, because what I'm really testing is, do we have asset unity? Remember, that's the second test into the apportionment rules. The two companies can be unitary, or you can have asset unitary as well. And that was the Allied Signal case, where basically they were saying that that assets that serve a business function of the company are have to be treated in a unitary fashion. So, and of course, about the only time that I can think of anyway that an asset by itself serves a unitary business, serves a unitary function, or serves an operational function in the company is when it's working capital. So basically, what I didn't, the fact that it didn't provide here was how long this investment was held. It was bought in 2019, sold in 2020, but I didn't tell you when in 2019. I didn't tell you when in 2020 it was sold. So this could have been an asset that was owned for less than a year. And if it's working capital, it's automatically apportioned, right? It becomes part of the pie, right? The pie. And if it's held for more than a year, well, then you evaluate, well, is this investment unitary? Well, how could it be? They only bought 1% of the stock, so how could it be unitary? 99% of the company is owned by completely different interests. So we would assume it's not unitary. So if it was owned for more than a year, the gain would not get apportioned. It wouldn't be part of the pie. But if it's owned for less than a year, it is part of the pie. With me? Okay, so let's go to part A. Can Connecticut require consolidated lint to allocate interest and other expenses against non-unitary income? And the question here, why might it require this? And well, the answer is yes. Whenever you have income that's being treated in a special way, you want to make sure that expenses are directly allocable against it. And so, so the answer here is, if Connecticut is going to treat this as non-unitary income, then it's going to want to take a certain amount of expenses and allocate it against that income, right? Remember, Connecticut can't really tax the, right, our company is headquartered in New York, so Connecticut, if this is going to be non-unitary or not part of the pie, Connecticut cannot tax it. They would have to exclude this gain. So at the same time, they said, well, allocate some expenses against it, because those are expenses that I don't have to, that's beneficial to Connecticut, right? Those are expenses that don't go into the pie as well. Part B, can Connecticut require consolidated lint to allocate all of its interest expense to offset non-unitary income? Well, you may recall this was one of the cases we discussed. This is the Hunt-Wesson case. And the government, the answer is no, the government can only require a reasonable amount of expense to be so allocated against non-unitary or non-unitary income. Let's just put it that way. All right, so it has to somehow rationally match up. The income and the expenses sort of have to align with each other. They can't require all expenses to be allocated against the tax-free income. All right, so questions? We good? Did I turn the chat on? Oh, wait a minute. I think we do. I think people have been trying to get a hold of me in the chat. Yes, sorry. Someone asked, what tax rate were we assuming? I guess that was on question 1. We were just assuming a 10% rate. Okay, that was it. All right. Okay, so part 5, question number 5 rather. Say instead that the Treasury unit purchased 30-day commercial paper of the company in May 2019 and earned $100,000 of interest income. Can Connecticut tax the interest income? And again, no, they can't. Clearly, this would be non-business income. And so therefore, it fulfills an operational function within the company. It is a unitary asset, and therefore it is apportioned. Question 6 is actually a trivia question. Who is the president of Consolidated Inc.? Does anybody know? Famous TV show? Gomez Addams of the Addams Family was the president of Consolidated Lint. Okay, number 7. In 2020, Consolidated Lint had nexus in New Jersey, the lint capital of the world. And if you can see through my window behind me, you will see it is the lint capital of the world. The company stores 90% of its raw lint inventory in New Jersey warehouses. New Jersey apportions taxable income using a formula that utilizes inventory property in New Jersey divided by inventory property all over the world. Accordingly, Consolidated Lint has a 90% apportionment factor in New Jersey. Part A. Is the business income earned by the company from the sale of inventory apportionable to New Jersey? And well, yes, of course. And the sale of inventory is always going to be apportioned, right? So this would appear to be a unitary business income is apportioned to part of the pie. We got one big pie. Okay, part B. Is the state's apportionment formula internally consistent? And well, yes. Remember, if every other state used the property over property formula, it would aggregate to 100%. There would be no concern over double taxation. Part C, that's Goldberg v. Sweet. Part C, if the company's plant and equipment, mines, labor force, and management are entirely located outside of New Jersey, does the issue arise as to whether the company is being subjected to fair apportionment? And here we would say the answer would probably be yes, right? Because all of the value drivers of the company are outside of New Jersey, and yet the one thing that New Jersey is utilizing to source the inventory or to allocate the profitable income of the company is the one thing that New Jersey has a lot of. So in this instance, while it is under Part B, we just established it doesn't fail internal consistency. We probably here have an issue where this is just unfavorable to this particular taxpayer, and he can make an argument for alternative apportionment. Now, you will recall in the book, and I think we said in class, it's very, very rare that you're going to actually see this in real life. And in fact, I picked the one scenario where property over property, as you may recall, is always a suspect type of formula because it's sort of unstable. It doesn't measure the contributions of employees, and in this instance, it's only focusing on a certain type of property, right? It's only on the inventory that's being stored in the warehouse, not on other property that the company owns. So part D is, what should the company be prepared to prove were it to petition for fair apportionment? And then what it would want to prove is that all of the things that make this company successful are outside the state or outside New Jersey and are not getting properly measured, so that New Jersey is grabbing too much of the pie for itself. Now, as a constitutional matter, well, actually, let me answer question E first. So which case is this closer than, Hans Reese or Butler Brothers? Well, this is Hans Reese on steroids, right? Because Hans Reese was a property over property case, and remember back in the 1920s when that case was decided, they thought, the taxpayer really was able to prove that there was gross distortion in this particular place by what they were measuring, how they were measuring the apportionment, and they sort of got away with it. Now, in juxtaposition to that case, you remember, was Butler Brothers, where they used a 3-factor formula of property, payroll, and sales. And to recall the facts of that case, the taxpayer was able to prove that in California he had a loss, but that the company as a whole made a profit, and that therefore the Supreme Court decided that this was a fair apportionment scheme, and we can take a national profit and turn it into a local profit, even though the taxpayer can prove beyond a shadow of a doubt that they had a loss in the state. And that's why our friend Professor Hellerstein in writing the book goes, you know, I really wouldn't bet that it's a matter of constitutional law, unless you had some crazy case like Hans Rees come up again. I doubt very much that anybody on constitutional grounds will ever win a fair apportionment case ever again. Although then later on, when he was discussing British land, he said, all right, this might be the one time I would take on a case like this if it was a British land type of fact pattern. But as things stand today, it seems unlikely that on constitutional grounds that we'll ever have another Hans Rees case again, because the states are smart enough not to use payroll alone or property alone as the apportionment factor. Now, what they do these days is the subject of question 8. So let's go to section 8. What if Continental Lint sold all of its inventory to a single customer in Maryland? Accordingly, its New York apportionment factor is 0, right? Because it's sales over sales. And its Maryland apportionment factor, also single sales, is 100%. And we will, of course, assume that they have nexus in that state. Could New York argue for alternative apportionment? So New York is getting nothing, right? Maryland is getting everything. And you might think so, but the answer is no. Now, this isn't a question in my mind that Hellerstein takes on at all. So I came up with my own answer to this question. So just be cautious out there in real life. You're not citing Hellerstein, you're citing me on this particular issue. And the reason I think a single sales factor is never going to be overturned on a fair apportionment issue is that it is looking at 100% of the output of the company. That's the only consideration being brought in. And if a state made that its formula, well, then it serves them right. And they shouldn't be able to argue for fair apportionment, nor should the taxpayer be able to argue it, because it seems as if you're going to just use the output of the company, the sales, as your defining line, well, then that's what you look to, and you can't argue for any that what went into producing the sale is creating a distorting result, right? If you're just going to look at output, then you shouldn't be shocked if all of your sales end up in one particular state, or it follows the customers of the company. On the other hand, if a state only uses property and doesn't use payroll and sales, well, then they're looking at property and payroll look at the inputs of the company. Here, they're not concerned with the sales, they're concerned with the expenses of the company, right? Not the income generating part, but the sales part. And if you only use property and not payroll, you're going to get a distorted result. Or if you only use payroll and not property, you're going to get a distorted result. Now, of course, the thing that's the most stable of all is to use all three: property, sales, and payroll. But in my mind, a three-factor formula won't get overturned on a fair apportionment issue from a constitutional perspective, nor will a sales-only formula be overturned from a constitutional perspective. But a property-only and a payroll-only, unlikely, but it's possible that it will get overturned as a constitutional matter. Now, I keep emphasizing constitutional matter because, in fact, taxpayers on a daily basis get their apportionment modified. I was working on such a case today, and that's because it happens under state law. Remember that the Constitution, even though we emphasize it in this class, The Constitution only creates a set of minimum guidelines around which the state laws have to operate. And if the state laws, and pretty much all of the state laws that adopt apportionment formulas, always throw in a relief provision saying that if we're not getting to the right result, then either side, the government or the taxpayer, can petition for alternative apportionment, but they're doing that under state law, not as a constitutional matter. Okay, so that's the answer to question 8. Okay, question 9. In February 2020, Consolidated purchases, I guess, did I misspell that? That should be capital C. Consolidated purchases the business of its competitor, Abigazint Lint of Bismarck, North Dakota. So in February 2020, they make this purchase of another company. Part A, are the activities of this business unit unitary with the operation of Consolidated Lint in 2020? And the issue that I'm asking here, we didn't spend a lot of time on it, but we did discuss it, and this is almost certainly going to be one of the 40 questions on the final, is the issue of instant unity. In some states, there is a rebuttable presumption that the acquiring company and the acquired company are not unitary in the year of acquisition. Does that mean that they're automatically non-unitary for the first year? No, it just means that we assume that it's not unitary. And if one party, either the government or the taxpayer, want to prove otherwise, God bless them, go ahead and do it. But they have the burden of proof. So they have the burden of establishing 51% of the evidence. Part B, 2021. Well, a year's gone by, probably the company is getting a little bit more integrated. So, but I would say that the states that embrace this instant unity theory, it really should be called the non-instant unity theory if we want to get into proper names. But generally, the presumption among these states is that it takes more than 2 years to become unitary. So again, in 2021, the presumption would remain that the target is not yet unitary with the parent. Now, by 2022, all right, now this is the 3rd year of the acquisition. By now, it has turned. The presumption is that the two companies, so long as they're in the same business line, are unitary. And if you want to prove otherwise, fine, go ahead and do it. But you have the burden of the party trying to disprove that they're unitary has the burden of proof, or has the burden of establishing. Okay, so with me on that, that's like a sure thing on the, you can sue me if I don't ask that question of instant unitary. And again, it's really more a rule of evidence than anything else, because it's not like it's a hard, fast rule. It's just who has the burden of proving that unitariness exists. Okay, so part 10 is, and here, I'm not sure in my zest to put this Q&A together for you, or actually it was just the Q's and not the A's. I am not sure if I gave you the answer to number 10, but I'm certainly not going to try to read you what is a one page of numbers type of answer. But let me just sort of describe what it's about. The Julian Javier, one of my favorite baseball names ever, corporation, he played in the 60s, has its headquartered in State Purple. During 2013, it received a dividend from a 60% owned subsidiary that is unitary with the parent in a factor representation state. Guess what? There are no factor representation states, but I was just being silly. Calculate the tax effect of the dividend on the taxpayer. So, and if I gave you the answer, great. If I didn't, you'll get it soon. But basically what you're doing is you're taking all of the factors of the parent and then you're taking 60% of the factors, the property, payroll, and sales of the subsidiary, and you're mushing it all together to create a unified factor. This number 10 describes a state of affairs that people have argued for but have never successfully implemented. So I'm actually illustrating an issue that simply does not exist. So nobody does things this way, but I wanted to illustrate what the factor theory or the factor inclusion theory was all about. So I'm not going to spend any more time on it. This is certainly not test material, but I wanted to show what the, you can actually write in bold letters, number 10, not going to be tested on. Okay. Number 11. XYZ has two subsidiaries, A and B. Corporation A makes semiconductors and sell all of its products to Company B, which markets the chips to third parties. As soon as you see a fact pattern like that, you say, ah, vertically integrated company, they're unitary. The parent company XYZ conducts research in developing new technology, which it licenses to Corporation A. Corporation A is located in California, Company B is located in New Jersey, and Company C is located in New York. All three companies are organized under the laws of Nevada. What is the significance of the companies being organized under the laws of Nevada? Nothing. It's just noise. I'm putting it in there just to sort of daze and confuse you a little bit. The state of organization is typically not important until I tell you that it is important. Okay, so we may have a couple of instances like that, but for the most part, it's not important. So again, not going to go through the answer here, but what I was trying to illustrate was that how a company can simultaneously be in a unit, could be in a combined reporting state and simultaneously be in a separate reporting state, and that therefore in the combined reporting state, they're going to mush all their factors and all of their income together. And then in the separate reporting state, like New Jersey used to be before 2019, only the company that has nexus in New Jersey is going to file separately. They're going to file their own return, and they're going to report income. They're going to report their income times their factors and not the income of the rest of the group. And which leads me to question 12. And this is more, again, not really a testable type of point. It's sort of a thinking kind of point. So if in 2018, New Jersey only taxes the single company that had nexus, but that company is part of a larger unitary group, is New Jersey failing to apportion the income of the full unitary group? This is a point made by Hellerstein in one of his like footnotes somewhere, and it's kind of an intriguing point, and it's really worth discussing for a second. And they're making an excellent point here. If a state requires companies to file one by one, they're really sort of breaching the unitary theory, aren't they? Right? They're sort of, now sometimes that might help the state, sometimes it's going to help the taxpayer, but they're really breaching the entire unitary theory when that's allowed, because the state is taxing less than the entire unitary business. So I wonder why no one ever brought this case, not that I'm aware of, ever brought this case saying that the taxation of a single company can be, under the right fact pattern, entirely contrary to the unitary theory, right? Because you're breaking the company up, not along business lines, but along legal lines. And that's the whole point of the unitary theory, is that you're trying to do this more, you're trying to ignore the form and get to the substance. And a state that taxes you on a separate basis is basically focusing on the form and not the substance, not the economic substance of the transaction. As you know from your federal classes, which is more important in taxation, legal form or economic substance? Well, 99.9% of the time, economic substance is far more important than legal form, right? And cases have been decided, famous cases have been decided, court holding company, I think, decided on that point. So extremely important, right? Uh-oh, I'm hearing myself. Okay, the echo went away. Good. That was really weird. So, all right. So that was sort of more of a thought-provoking type of question, number 12. And then 13, I don't even know why 13 is there. You could ignore 13. 14. Okay, there is a variance in how the states approach the unitary principle. Why did I put a question mark there? I should take that out, which is discussed in the book. Make that a period, not a question. For example, Arizona adopts, oh my God, what language am I writing in? Arizona adopts, take the 2 out, adopts the operational interdependence test. So in other words, Arizona has a different definition of a unitary business than the US Supreme Court does. So my question here is, and this is circle 14, because I'm going to ask this on the final, okay? Can the state have a different definition than the federal treatment of a unitary business? This is an important point, and Arizona is probably the best example of this. They say in order to be unitary, the company, Division A has to sell assets to Division B. It can't, that's the only thing we're interested in determining what a unitary business is. So can they do that? Can they get away with that? And the answer is yes, so long as the law, this new definition of unitary, makes it harder for the state to tax companies that are headquartered in any of the other 49 states. Okay, so in other words, no, I don't know if in other words, in the same words, they can make it harder to be unitary. They can't make it easier to be unitary. So in this instance, my example is Arizona only focus, it has to be operational. It's limited to unitary is limited to situations where Division A is selling to Division B. That's okay. That makes it harder for Arizona to tax California companies. What if they made it, they went in the other direction and they made it an easier standard than the federal? Let's just say they just said, okay, if you own another company, you're unitary. Well, that would make it easier. That would make it easier for Arizona to tax a California company or a New Jersey company. So so kind of maybe just memorize that, okay? Just circle 14 and say that is a sure thing for the final, okay? A state can adopt a more stringent standard of unitary. They can't adopt a more lenient standard of unitary. So in other words, the Supreme Court decisions are just sort of like a base case. The states can adopt from that, but they can make it tougher to tax companies from other states. They can't make it easier to tax companies from other states. Maybe that's the best. Maybe that's the way I should have said it originally. Okay. So 14 is an important point, and we're actually going to return to that point later on. Okay. And then there's number 15, which is our last question for the first half of Chapter 7. General Big is a holding company operating in New York. Its auto rental subsidiary is located in Houston, Texas. Its fast food franchising subsidiary is located in North Carolina, and it owns a National League Baseball franchise in yet another subsidiary. Will this company be able to file combined in the 25 states that have combination laws? And this is sort of a trick question. You might think, well, no, this is a non-unitary company. They can't be required to file on a combined basis. Well, not necessarily. They could be required to file combined, but they have to file under separate apportionment pools, right? Just as a single company can own 5 different businesses and they apportion them all separately, same thing with a group of companies. You can force them all onto the same return, but you can't force them to apportion all of the income into one return or into one apportionment pool. So in other words, just as if you can have 5 separate pies within a separate company, you can have 5 separate pies within a combined group, so long as they're non-unitary with each other. And here I have, what do I have? I have a fast food restaurant and a National League baseball team. Unless they're selling fast food at the stadium, it would probably be difficult for them to argue that they are unitary. Oh, let me think of an exception to that. If the Wrigley family still own the Chicago Cubs, they don't. If they still own the Chicago Cubs and they said, well, we operate the Cubs to help sell Wrigley chewing gum, they might have an argument that that one's a baseball team, the other's chewing gum, that maybe they should be considered as a single unit. Not the most convincing argument in the world, but there might be some substance to that. Okay, with me? All right. So before I switch on to Udipta, how about we have some questions? Are you all completely lost? Some assurance at this point would be nice. Okay, with me? All right, I guess we'll go on to Udipta. Wait, hold on one second. I just want to organize my notes. Okay. So the Udipta statute that's in the book, and I forgot to bring a copy of the book. I'm gonna excuse myself for a second and get a copy of the book. Take a 2-minute break. I'll be right back. Okay, I'm back with the book. All right, so I'll open it when I need to. So, okay, so the Udipta statute, which is in the book, is what is called a model law. And the states typically, to have uniformity in their approach to topics, they really don't, unlike the Congress, have their own professional staff that write the laws. What often happens at the state level is that professors write the laws on behalf of the states in what are so-called model acts. And then the states look at the model acts, and sometimes they adopt them word for word, sometimes they adopt them most of it, but not a couple of sections. And probably the best example of a model law is the one that you're familiar with from your accounting programs, which was the Uniform Commercial Code, right, which governs commercial transactions in the United States. So that was, I think, adopted back in the 1950s, right around the same time as the UDITPA, kind of hard to pronounce, UDITPA Model Act, written in the 50s. And many states adopt this. Not everybody adopts it word for word, but I would say it is a model that is used by pretty much all of the states. You recognize, as you read the laws of the states, you recognize entire sections almost word for word out of this model act. recently, there's talk, and for those of you that bought the 11th edition, you can see the proposed changes that they want to make to UDIPTA. It's probably not happening anytime soon, but so sort of ignore that. The proposed changes are in italics. I think you can just sort of ignore that for the time being, for those of you with the 11th edition. And like any law, probably the best way, whenever I'm looking at a law for the first time, the first thing I always go for is to look at the definitions. What are the key words that are going to have a special meaning for this particular statute? Because if I don't know the definitions, I'm inclined, I may interpret a word sort of in the generic sense of the word. Like, for example, one of the special definitions in section 1, I think it's 1F. Wait, maybe not 1F. Well, one of it, somewhere in section 1, they define the word state. So later on, when you're reading, if you don't know the definitions ahead of time, when you read the word state, you might literally think they're talking about one of the 50 states. But as we shall see, they're referring to more. Like, for example, included in their definition of a state is Puerto Rico. The District of Columbia is a state. France is a state. Germany is a state. Any foreign country is a state. As far as this is concerned, like, who would have thunk that if you hadn't read the definitions ahead of time? So I think it appropriate to sort of go through, they don't have a lot of definitions here, but I think it's probably appropriate to sort of look at them right now, and just for a few minutes. And then at the same time, to look at the comments that are underneath it. Now, the comments are not actually part of the official law, but sort of unofficially, they are a part of the law. That they sort of explain what they're getting at. And by the way, this is, as you know, if you've looked through it, this is a very short law. It's very pithy, but it gets right to the point. But the comments are sort of crucial in interpreting it. Okay, so after I would go through, well, maybe we should start at section 9 of the law, which works off of the section 1A definition of business income. Section 9 says that business income is going to be apportioned. And the next few sections, 10, 11, 12, 13, discuss how the apportionment formula is going to work. So 1A goes, if you're in a 1A, if the type of income that you have is 1A income, it's going to be apportioned under the rules that start under section 9. So let's look at the definition of business income. And rather than read the whole thing out, there are two key words that I find of particular interest in the definition of business income. And we are going to get to them tonight. One quickly, one maybe towards the end of the evening. And it talks about income that's earned in the regular course of the taxpayer's trade or business if the acquisition, management, and disposition of property constitute integral parts of the taxpayer's regular trade or business operation. So the two words that I'm emphasizing are the word the and the word and. And we'll get to the significance of those quickly, okay? So now that we've defined business income, these are things that occur in the regular course of business. it begs the question, what is non-business income? And I think if we look at 1E, we see that non-business is described as any income that is not business income. How's that for an easy definition? So basically, your entire universe are two types of income, business income and non-business income. You can't have anything else. It's either one or the other. It's either yes or no. It's binary. It's one thing or the other. It's like pregnancy. You are or you're not. You can't be somewhere in the middle. So that's how they're defining the word. So anything that's not business income is non-business income. The significance, how is non-business income going to be sourced to the states? How is it going to be divided up among the states? Well, that's going to be the subject of chapters or sections 4, 5, 6, 7, 8. And then business income is going to be the subject of sections 9, 10, 11, 12, 13. And it goes on a little bit more from there. So one of the words I emphasized was the. So the regular course of the taxpayers, trade, or business. Now, the word the is very interesting because it seems to signify, or it seems to imply, that a taxpayer can only have one trade or business, right? So if a taxpayer has got 17 different disparate businesses, that they're all treated as business income, as a single source of business income, right? That would sort of be contrary to the constitutional overlay of there being only unitary businesses can get a portion. So already they've gotten themselves into trouble because in defining business income, they sort of are saying that, oh, screw unitary and non-unitary, we don't care about that. All of your business income should be apportioned via Section 9. And for some reason, they only make it clear in the comments. So here's like a critical, if you look at the comments to Section 1, they say that a taxpayer, they say, we made it sound in the statute like we're only taught like a taxpayer can only have one business. No, that's not true. Don't interpret it literally. Interpret it liberally. And so in the comment it says that a taxpayer can have more than one trade or business, which is good that they said that because otherwise this whole model statute would have been unconstitutional, right? So the unitary concept is alive and well in the UDIPTA statute. Okay, I'm done with that page. All right, next definition I want to look at because it's going to be referred to over and over again is the definition of commercial domicile. That's in section 1B. It's the principal place from which the business is directed or managed. So the model law is adopting, remember there were two ways of thinking about commercial domicile. Every company has one domicile, and some states define it, follow the UDIPTA statute and follow the brain theory. It's where the brains of the company, it's like where the leadership of the company is located. The other theory not covered, which isn't embraced by UDIPTA, is the Braun theory, that the commercial domicile is the state where the company has most of its assets, or more than any other state. There's more assets than it has in any other state. Okay. The comment is interesting on commercial domicile because it refers to that the company is, the commercial domicile is where the company is directed or managed. They sort of created, again, with their literal language of the statute, they created a little bit of difficulty for themselves because, well, are directed and management synonymous? Well, not in normal English. They mean different things, directed or managed. But in the comment, they said, oh, you know what? Just treat directed and comment as just two words saying the same thing. So they're giving a rule of construction there. Just treat them as the same thing. Now, it may not be obvious to you why directed and managed are two different things. So let me just sort of explain. Corporations are normally have two groups, right, at their head. They have the board of directors, directed, and they have the management team, right? The CEO and everybody else, they manage the company. The directors direct and the managers manage. So to get that where the words sort of come together. So under the brain theory, they're focused not on the board of directors, but they're focused on management. They're saying it's where the chief executive officer and the chief financial officer, where they sit, that is the domicile. That is the commercial domicile of the company and no other state. Now, why isn't the board of directors? Remember, the board of directors is sort of the representative of the shareholders. They're there as a board. They can only do things as a collective body. They can't do things. They enjoy no executive action within the company, and basically, if the board of directors was the place where the board of directors meet, is the place where the company is domiciled, you would have no companies domiciled in New York. They would all be in Bermuda or Hawaii, or because boards of directors tend to meet on the road in some really nice vacation spot. That's why I'd like to be a director someday, because they usually get paid a few $100,000 a year to meet 2 or 3 times a year, usually in some vacation spots. So you get a free vacation out of it. And usually they don't do much. They blame management for anything that goes wrong. So I would like to be, and just in case something does go wrong, like the company melts down, they're all covered by director insurance. So that's why my next gig is to be a director. See if all I lack is the credibility to do the job. So, okay, so those are my definitions. So now that we went through that, let's go back to the questions. And let's go to question 16. Oh, I'm doing good on time. All right. So, number 16. Company ABC collects trash from homes in certain New Jersey and Pennsylvania townships and also manufactures semiconductors from plants in New Jersey and Pennsylvania. How many different business segments is the company in for purposes of UDIPTA? Well, again, we just covered this. The answer is in the section 1A comment. A single taxpayer can be in more than one business. So in other words, you can have 1 pie, 2 pies, 3 pies within the company, and section 9 applies separately to each of those divisions. Okay. Number 17. Company XYZ is organized under the laws of Delaware, has its headquarters with 50 officers and executives in New Jersey, and its main plant in Pennsylvania with 5,000 employees. In which of these 3 states is the company domiciled for UDIPTA purposes? Well, 3 states were offered. Let's go through them all. Organized in Delaware. Is that important? Never. It's important if you have to pay the Delaware shares tax, but that's about the only reason for that, right? So it's not important. It's completely unimportant under UDIPTA where you're incorporated. Okay, so now I'm illustrating the brain theory and the brawn theory. Well, UDIPTA follows in section 1B, follows the brain theory. So clearly the brains of this company is in New Jersey. Great brains want to be near me. What can I say? Number 18. Can company XYZ have more than one domicile under UDIPTA? Well, no, that's the whole point. You can't have more than one domicile. People can't have more than one domicile. If you can have 30 homes, you can only have one domicile. Same thing with corporations and businesses. They can only have one domicile. It's a concept under the law. You have to sort of live it. Okay. Number 19. Could a company be domiciled in Ohio under the laws of Ohio and in Michigan under the laws of Michigan? the answer is yes. Remember, not all 50 states adopt UDIPTA, right? Some do, some don't. I think I mentioned earlier, you sort of see, whenever you look at a state, you see sections of it, but they don't necessarily have to adopt section, what was it, 1C on the definition of domicile. A state is free to adopt it differently. I think out of the 45 states, 45 follow the brain, 5 follow the brawn, and it's altogether conceivable that a company can be domiciled in 2 different states, and it's just tough luck to be in that situation. That's probably something that you want to plan around. It would probably not be good, for reasons that we will shortly see, to be domiciled in 2 different places. Okay. Where am I? Okay. Okay, number 20. Now, this introduces section 2 of the law. So maybe we should go to section 2. And it's section 2. There is no good reason for section 2. It is basically just an outrageous, crazy trap for the unwary. It's probably, you've heard this phrase many times before in the course of your tax education, the so-called trap for the unwary. That if you don't know what you're doing, you accidentally fall into this trap. Section 2 and Section 3 are the right to apportion, or the right to divide income up. Basically, it says what seems to be an obvious point. They say, in order to divide income up among the states, you actually have to be doing 2 different things. You have to have business activity in more than one state, and you have to pay tax in more than one state. That seems kind of obvious. If I'm doing all my business in state A, then shouldn't I pay all my tax to state A? That shouldn't be an issue. Except that it ends up being a trap, which we'll see in a second. So Section 2 states this rule that you have to be in more than one state and pay tax in more than one state. And then Section 3 describes, okay, what type of a tax that tax has to be. As you will see, I put together a lot of questions on this point, because, not to belabor it too much, but because it's so important. If I had a nickel for every single time I've seen people disregard this rule to their outrageous detriment, I could buy all of you coffee. That's how often I've seen it. Don't fall into this trap. All right. Number 20. Taxpayer is organized under the law of state A, not important, and has its factory in state A, that is important. It ships all of its widget products via common carrier to a customer in state B. How do we divide our income up? How do we divide our income up under Section 2? Well, guess what? We have business income because we're selling inventory, but we don't get to Section 9. In fact, we don't get past Section 3 because we're not entitled to divide our income up. Because if we're shipping from state A and we're selling to state B, but that's it, we have no other connection to state B, then it's highly likely that we're not a taxpayer in state B. I probably should have said, oh, no, I did say it via common carrier. Okay. So the answer to number 20 is that this guy is going to pay 100% of his taxable income to state A. All right, maybe that doesn't seem so unfair. Let's go on to number 21. Same as the previous question, except that taxpayer employs a person in state C, so I'm introducing a new state, okay, and accordingly pays an income tax in state C because they have nexus in state C. Okay, how much now do we pay to state A? Well, we actually may pay nothing to state A at this point because what is our likely apportionment? Well, as we shall see, when we get to section 9, we will find out that when we're shipping tangible personal property, when we're shipping stuff, all of the income gets sourced to the state where you're shipping it to. So under 21, our apportionment is 100% in state B. And so why wasn't that? So 0% of our income gets sourced to A, 100% gets sourced to B, except that we may not have nexus in state B. And we also, all right, we file a tax return in C. So should the difference between paying 100% in state A and paying nothing in state A rely upon such an insignificant fact that I have one single employee in state C? It seems crazy, doesn't it? But this is the law of, I would say, about 40 of the states, that you have to be able to prove that you have operations in another state. You're 100% unless you can prove that you're a taxpayer in one other state. You'd be surprised how hard that can be sometimes. All right, so the answer to 21 is taxpayer now has the right to apportion income. He gets to section 9 because he's taxable in more than one state. What a difference in result. Should so much depend upon such a small presence in state C? I think not, but that's the way it rolls. Okay. What if, number 22, what if state C in the previous question is in Puerto Rico? Well, you might say, well, so what? That doesn't help me. Puerto Rico's not a state, except that what? We've already established this. How is state defined? State is defined liberally. It includes Puerto Rico. It includes literally the territories of the United States, the federal district, which is the District of Columbia, and it includes foreign countries. Well, so basically it includes every spot of land on Earth is a state for this purpose, right? Everything is gonna fall into one of those definitions, except maybe like some island that nobody claims in the middle of the ocean. So, so what if in state C what if they had a man in Puerto Rico? That would create the right to apportion out of state A. Okay. 23. What if state C in question 21 is Washington, D.C.? Same result. Meets the definition of state in section 1H. 24. What if state C in 21 is France? Same result, same definition of state in section 1H. Okay, 25. What if state C in question 21 is in Arizona, which imposes a privilege tax of $10 a year? So now the question is, am I paying, do I have the right to allocate? Do I have the right to divide up income? Am I paying, remember, section 2 says have to be doing business in another state and you have to be paying certain types of tax in this other state. And then section 3 defines, okay, what are those different taxes? So now it's time for us to enjoy section 3, which, and here again, the comments are going to be important. But let's get to the comment in a second, all right? So the terms of section 3 say the tax that you're paying in the other state can be a net income tax. It can be a franchise tax measured by income. It could be any franchise tax for the privilege of doing business in the other state, or it could be a corporate stock tax. So any of those things will do it. And then it says, or, and now here's an exception that swallows the rule. The state has jurisdiction to subject the taxpayer to a net income tax, whether he chooses to do so or not. So in other words, so long as the company has sufficient nexus in that state in order to allow that state to impose a tax. So let's now go back. What am I up to? 25. What if state C in question 21 is in Arizona, which imposes a privilege tax of $10 a year? So do they impose an income tax? No. Do they impose a franchise tax measured by income? No. Do they impose a franchise tax for the privilege of doing business? Yes, they do. That's what a privilege tax is. It's for the privilege of doing business. So it's $10 a year. So what? That's sufficient. They're now paying a tax. They're doing business in another state, and they're paying tax in another state. So okay, so we meet the test. Number 26. What if state C in question 21 is state red, which only imposes a sales tax? Well, this isn't very good, because the sales tax is not one of the taxes that's listed, right? It's not a net income tax. It's not a privilege tax measured by income. It's not a franchise tax measured by privilege. It's not a corporate stock tax. You would say, not good enough, except what could be your saving grace? It says the state has or the state has jurisdiction to subject the taxpayer to a net income tax, which it either chooses to do or not to do. So basically, that could probably likely get you out of trouble, because the state probably, if you have enough connection there to pay a sales tax, you might also, or highly likely to have enough connection there to have to file an income tax as well. So again, you would have to prove that that you could be potentially subject to an income tax in state red. Okay, 27. What if the employee in state C is a salesperson and that all of the conditions set by Public Law 86272 are met? Accordingly, the state cannot impose its income tax. The state imposes no other taxes on the taxpayer. Are we in trouble now? Because it seems like they can't impose they can't impose even an income tax. They can't even hypothetically impose an income tax. Well, you would think that that might be a problem. But, and wait, I have to read my note here for a second. Yeah, so I think what we would, I think what might be, well, I'm sorry, I'm being confusing, aren't I? So you would actually, the strict language, if we were to just read the rules of section 3 literally and leave it at that, this is where you're disadvantaged, right? Because while they will relieve you if you actually pay the net income tax or a franchise tax or a corporate stock tax, the only hypothetical tax that the statute itself takes into consideration is an income tax. But look at the comments. The comments always bail us out. The comments say that, and why did they just write it this way? But in the comments I go, oh, when we say that the hypothetically it's only an income tax, it should really be interpreted to say hypothetically you're subject to any of the other taxes as well, that you could be subject to any of the other taxes as well. So while 86272 would in this situation prevent state red or state C from imposing a tax, Public Law 86272, does that stop us from invoking a privilege tax? Absolutely not. So the fact that hypothetically we would be subject to that franchise tax wins the day for us. You would never get to that answer just reading the words of Section 3. You have to read the comment to Section 3. Would I be ghoulish enough to ask you a question on the final that would require you to understand something that's in the comments and not in the statute? You bet your life I would. So if you have your book open, underline the comments, okay, to Section 3. So the answer to this question is that he probably has the right to divide income up among the states because he can point to the fact that he is hypothetically subject to a franchise tax or a capital tax. There's nothing stopping a state from imposing those taxes on him. Okay. 28. What if in question 24, the taxpayer's presence in France is such that it would be unconstitutional to tax that person if the person was in a state rather than in France? I can't actually think of a good example of this, but if you read the comments to Section 3, they said this would not meet the standards of Section 2. So if you're in another country and that other country cannot impose, maybe because you lack sufficient nexus in that other country, that under our standards, if France was New York, they couldn't impose a tax on you, then you would not meet the standards of Section 2. You would not be able to divide income up. What can I tell you? It's there in the comments. So your presence in the foreign country should be sufficient presence to subject you to tax, not under the laws of France, but what would be the law if France was New York? Would New York be able to tax you on? Would you have sufficient presence in France that New York, if New York was France, would be able to tax you? All right. Did that make any sense? Did anybody get that? Read, if you're not getting it, read the comments to Section 2. But I think that's what they're getting at. Your presence in France better be the equivalent of having nexus in France. Okay? Just because the US-France treaty requires you to pay tax in France doesn't mean that it's a sufficient enough presence for state purposes for you to be subject to this hypothetical tax in France. All right. 29. What if state C is Delaware and it is unclear that taxpayer owes the Delaware shares tax, but the taxpayer pays it anyway? And why does the taxpayer pay it anyway? Because he wants to be able to divide income up. He doesn't want to pay 100% of his taxes to state A. With me? So he pretends that he's subject to tax in another state and he pays a $10 tax to Delaware and he avoids paying a $1 billion tax in New York. Is this going to work? And if you look at the book, it's a footnote in the book, but it says Richardson Investment Company was the case. Somebody actually did this. And so let me just tell you up front, making believe is never a good option. If you're going to play this game, make it believable. And if somehow State A figured this out and they said, oh, you only paid a $10 tax and it wasn't even clear that you owed this tax, oh, well, then we're not going to say that that section 2 and 3 were met, and therefore you cannot divide your income. You're going to pay 100% of your income to state A. So this is always a temptation, frequently in tax. Just pretend that you're subject to a tax, send them $10. You're always thinking to yourself, why would another state, if I'm going to send $10 to state, why would they turn it down? Of course they're going to take it, right? Why wouldn't they take it? But unless you can't, it has to be a tax. It can't be a voluntary contribution that you made to another state just to get out of the Section 2 problem. Okay, so that's it. I kind of belabored the point with a lot of examples, but I thought it was worthwhile because that is a frequent trap. Okay, the proverbial trap for the unwary. Any questions on questions 20 through 29? Speak up. Any of you 87 that are out there? No? Okay. I guess I'm getting good in my explanations. Haha. Okay. Let's move on to, so now we'll assume that you don't have a Section 2, Section 3 problem and that you're entitled to divide up income. So once you're entitled to divide up income, your only question left in your mind is each dollar of income, dollar for dollar, go through all your income, is it business income or is it non-business income? Those are our only two choices, right? Business or non-business. So let's get into that divide, all right? And now we introduce another vocabulary word, although it's not actually in the definitions. It's a specific definitional word that they use, but they don't bother defining it. But business income is apportioned and non-business income is allocated. Business income is apportioned via Section 9. Non-business income is allocated pursuant to Section 4, and then after 4, 5, 6, 7, and 8. So sections 4 through 8 cover non-business and the allocation of income. What does that mean, the allocation of income? Well, we're just going to have to look at those sections because it means a variety of different things to cover a variety of different situations. Now let's go back to business income for a second, because as I said earlier, business income seems to align very nicely with what the Supreme Court refers to as unitary income at the federal level, right? It's each case they're describing what. Here, you can't really see me, but I'm making that pizza thing with my head. It's in each case they're describing a pie. And it's probably tempting to say that business income equals unitary income and non-business income equals non-unitary income. And I would say that's only correct 95% of the time. And of course, as tax people, we're always interested where they don't exactly meet up, because that's our zone of opportunity, right? To get different answers. And so I would ask, the first thing I should ask is, being that this is a statute, is by defining business income in a way that's only 95% compliant with unitary, is that okay? Is that constitutional? Do we have is this statute unconstitutional because it's defining the pie differently than the way the Supreme Court defined the pie? And I think this is an interesting question, but we kind of already covered it tonight. Remember, earlier tonight we said the states can define unitary differently so long as it's more liberal. Well, the same thing with the statute. A state can define taxable can define business income in a way that's more liberal, just so long as it's not more, it goes in the other direction of being more inclusive. Again, what would be constitutional? If we adopt a definition of business income that makes it less likely that a state can tax companies domiciled somewhere else, then it's okay, right? So this comes under sort of the same classification as the state definitions of unitary. Why as long as they're more lenient to non-residents of the state, they're fine. So business income and the business non-business distinction has to be evaluated under its own terms. All right. All right. So now let's get to, and I only devoted 2 questions to it, and it's sort of this is sort of probably the most, in a way, in its own crazy little way, maybe the most complicated thing we're going to discuss tonight. And it's not really that complicated, so you know it's going to be an easy night. So you may recall that earlier tonight, when I read the definition of business income, I sort of emphasized 2 words. I emphasized the to mean, they didn't really literally mean the, because they meant, the comments made clear that it wasn't, a taxpayer could have more than one pie, or could have more than one business. Here's a more complicated part. It says business income is income that's earned from the regular course of the taxpayer's trade or business if the acquisition, management, and the disposition of that property are integral parts of the taxpayer's regular trade or business. Here's where we get to a tricky point that is actually not covered by the comments. And instead, it has played itself out in the courts of the 50 states as to how that word "and" is supposed to be interpreted. Now, normally when we see, and tax statutes are full of this construction, where they'll give a long list of things, and then at the bottom it's either says and they mention the last thing, or they mention or and they mention the last thing. So something has to be A, B, C, D, and E, F, or it has to be A, B, C, D, or F. Well, that's why you always start at the bottom of the sentence. When you see a long sentence, you always go to the bottom of the sentence, because if it's and, it means all of the prior conditions have to be met. Or if it's or, it means only one of the prior conditions have to be met. So here, the focus is on if the 3 things: acquisition of the asset, the management of the asset, and the disposition of the assets are integral parts of the taxpayer's business. Or should it be read, the acquisition, the management, or the disposition of the property is an integral part of the taxpayer's trade or business. Okay. So what is the significance of this? Well, if a company is manufacturing inventory, I think we know that the acquisition of the raw material or the product, the management of the product, and the disposition of the product, all of those things are present, right? And so naturally, buying the inventory and then selling the inventory, that's all part of a business, right? There's no question that that's business income, because all 3 things are present. But what if or what happens when a company sells its machinery? Because and this is the scenario that this issue usually comes up. So instead of, let's say a company makes widgets, instead of when they sell their widgets, that's certainly business income. But when they dispose of the asset, is that income that's earned in the ordinary course of business. So the and the or focuses on when you sell something that you don't normally sell. You sell a non-inventory item. So there are two schools of thought among the states. There are the so-called functional states, which apportion everything, and there are the transactional states, which only apportion or only treat as business income the sale of inventory. The sale of non-inventory is treated as non-business income to be allocated under Section 4. So again, to repeat it again, and I personally can never remember these two names. I always mix them up. So, but I'm happy that I'm reading my notes right now. I always mix these two up. The functional test means the functional states apportion everything. The transactional states only apportion or only treat as business income the sale of inventory. All other assets are non-business income. Hopefully you're with me so far. Here's where I'm going to be dangerous. If you think about it, the functional states are not really reading the and as and, they're really reading it as or, right? It's the only way you can get to the sale of machinery as opposed to inventory, because if you read, okay, let's think about, I'm only going to confuse you, but what the heck, I can't, it's like I can't resist confusing you. If the acquisition management and disposition, well, that's not typically your business. That's not really your business, is dispose of your capital assets. You only dispose of them once in a blue moon when they wear out. So you need that to really be an or to get to that conclusion. The transactional states are taking it seriously. They're saying, no, the and should be read as and. So therefore, your regular course of business doesn't include the sale of the disposition of capital assets. You know what? Don't worry so much about my and as an and my and as an or no means yes, or yes means no. You know what? Just ignore that. Just know, this is what you have to know. The functional states treat the sale of all assets, inventory and non-inventory, as business income. The functional states do that. The transactional states treat only inventory as business income. The sale of non-inventory is non-business income. When is this important? Oh my God, this is so crucial, and this is an issue where you can make a lot of money for people, because people don't even appreciate that there's a difference between the functional and the transactional tests. But when a company sells all of its assets, right, that's going to be subject to tax in the functional states, and that's not going to be subject to tax, not subject to tax in the transactional states. Okay, so that's crucial. So that's very, very important to know if you're working with the sale of, not of inventory, but of the business itself. Okay, because sometimes the entire business gets sold. I dare say that over the next 3-4 weeks, we're going to see a lot of businesses being sold because they're probably not viable, right? The nature of capitalism, the strong swallow the weak, right? I think you can see a lot of businesses, unfortunately, it's very, very sad actually, but I think you can see a lot of businesses just terminating and selling their assets, and well, be aware that in the transactional states, those sales are not going to be subject to tax. Okay? With me? Or treat it as non-business income. Well, how about I say it that way? Okay, so having said that, let's go to questions 31 and 32. I feel good. It's 20 to 9. We're already up to question 31. It's nice. All right. The Poo Company, of course we have 75, so, but next week is another day. All right. Business income, non-business income. Question 31. The Poo Company is organized under the laws of Delaware and headquartered in New Jersey. The company manufactures honey in factories in 5 states: Vermont, Rhode Island, Georgia, Arizona, and Brown. In 2020, the company made $40 million from honey sales. Is this business income in Brown, which adopts UDIPTA? Well, of course, the company makes honey. That's its inventory. Is the sale of inventory business income? Yes, every state, right? Functional, transactional, doesn't matter. They all treat the sale of inventory as business income. 32. In 2013, the company sells its Arizona plant for a $4 million profit. Is this business income in Brown? Well, it would depend upon if Brown was a transactional state or a functional state. If it was a transactional state, the gain on the sale of the plant would be apportioned, and in a functional state, it would be, wait, did I get that right? See, I told you I can't remember these two. If it's a transactional state, it's non-business income, right? The sale of the plant, and therefore would be allocated. How it would be allocated, I can't tell you yet because we haven't gotten to those sections. We will be patient. We will find that out soon enough how it will be allocated. Okay, but if Brown is a functional state, that income from the sale of its plant will be apportioned, will be business income, and therefore will be apportioned under Section 9. Okay. How brutal was that? I think that was the trickiest thing we're covering tonight. Okay, so the next topic, we already sort of discussed it earlier, was the allocation of expenses to non-business income. So Section 4 speaks to the fact that non-business receipts or I wish I had Section 4 open. Hold on, let me go get it so I can give you the exact language. Assuming I can find it. It's in Chapter 7. Right? If I was organized, it'd be dangerous. Ah, here it is. Okay. Section 4. Okay. Rents and royalties from real or tangible personal property, capital gains, interest, dividends, or patent or copyright royalties, to the extent that they constitute non-business income, shall be allocated as provided in sections 5 through 8. So again, Section 4 literally only applies to income. So we have non-business income that's not going to go into the pie. It's going to get allocated. It's going to be divided up under a different set of rules. So the question I'm posing is, should expenses be allocated to the non-apportioned income or to the allocated income? And Section 4, under its own terms, is silent as to that point, But again, go to the comment under section 4, and it said, well, you know, it'd probably be a smart idea to allocate, if we're going to have non-apportionable income or allocable income, we should probably match up the expenses. But you know what? We're going to leave that to the discretion of each of the states that adopt this law. We're going to give them freedom to do what they want on that particular subject. So question 33 can only be answered by the comment to section 4, which is to say that they leave it to the discretion of each of the adopting states to include that in 4 or not. I would say most states specifically say to match up to the best you can, match up the expenses with the income. So the question I had, just to give you an example, Jones Corporation manufactures widgets. In 2020, it earned $3 million of interest income that is considered to be non-business income. The treasurer of the company was in charge of the investment of excess cash. Should part of his salary be allocated against this income? And, you know, again, probably the majority rule is probably yes, that most states would have you allocate some of his salary to that. Okay. All right. Number 35, rental income. Now we're going to get into the specifics of how allocation works. All right. So rental income on real property. Y Corporation is organized under the laws of Delaware and is domiciled in New Mexico. The company is in the business of leasing the buildings it owns to tenants, buying and selling properties with frequency. Should its rental income and related expenses be allocated or apportioned in the states where it has buildings? Well, Section 5A addresses this point. It says, 5A says to allocate rent on real property. However, Section 4 limits, now we have to go back to Section 4. Section 4 says that Sections 5, 6, 7, and 8 should only apply to non-business situations. So, and that's sort of the critical point of allocation, is that not all of the categories that could be included in allocation are really literally included in allocation. It comes down to a judgment call as to whether or not this is business income. So going back to our facts, the company is in the business of leasing out buildings. It's a landlord. So should the rental income should it be apportioned or should it be allocated? Well, of course, under section 4 would override section 5A and put you into section 9, which is to say, because it's a business, it should be apportioned. So the answer to 34 is the income should be apportioned, because when you read the facts, it certainly sounds as if they're in a business. All right, so not all rents and royalties are going to get allocated by section 5. Only the non-business rent and royalties. Okay, it's 35. X Corporation is organized under the laws of Delaware, is domiciled in New York, and is in the widget business. It leases land it owns, but is not using to another company. The land is located in State Blue, a state that adopts UDITPA. Should the resulting rental income and related expenses be allocated or apportioned in the state where it has buildings? Okay, well now we don't have business income because this company is not normally a landlord, right? It normally does other things. So this is not, what is it in the regular business of doing? So we go to section 5A, because this is non-business income. And what does it tell us? It tells us to allocate the income from real property to the state where the real property is located. So that's allocation. So finally, we're seeing a real life application of the word allocate, which means not to apportion via a formula, but put it all in one particular place. And now we're going to go through the rules by what does that mean? What does allocation mean? For real property, it means sourcing that income to the state where the real property is located. Okay, now part A to 35. With the expenses, all right, well, we covered this already. With the expenses of X corporation directly relating to the building, taxes, interest on the mortgage, should they be allocated as well? And in this subject, I would say yes. UDIPTA here in section 5A refers to net rents are allocated, or yeah, are allocated. So so there, I would say very clearly, it's a net concept that they're employing. Okay. Our next subject is net rents from tangible personal property. 36. Z Corporation is organized under the laws of Nevada and is domiciled in Cleveland, Ohio. The company leases construction equipment to contractors. Should its rental income earned from leasing equipment in state blue, a state that adopts UDIPTA, be allocated or apportioned to state blue? Well, clearly, first question always is it business or is it non-business? Well, this guy is in the business. That's all he does is lease out construction equipment. So it's not allocable. It's not non-business income. It's business income. Business income gets apportioned under section 9. Okay. Now, let's go to part A. If Z rents out an old truck that it is no longer using to a person resident in state blue, should this income be allocated or apportioned to blue? Well, section 5B1 says net rents from tangible personal property are allocable to the state to the extent that the property is utilized within the state. All right, so first we did the rule on real property, right? That gets allocated to the state. Tangible property, remember we have two types of property, real property and tangible property. Well, here we're a subset. We have tangible personal property. To the extent, again, same rule as real property. To the extent that the tangible personal property is in a state, we allocate, and it's non-business, we allocate the income to that state. But it gets a little trickier. Part B, what if the taxpayer is not subject to tax in state B because B does not impose a tax and because taxpayer is not organized under the laws of blue? Well, in this case, there's a backup rule. It says all income should be allocated to the state, in this case, Ohio, the state of commercial domicile, provided that Ohio is a UDIPTA state. So that's section 5, I'm sorry, that's section 5B2. So if you're not allocable, if the income doesn't get allocated to the state where the property is in because that state doesn't impose a tax, then it gets, the secondary rule is that it gets allocated instead to the taxpayer's state of domicile. Okay, part C, what if the truck is used in 3 different states? Well, then we go to section 5C, which tells us, gives us a days over days formula. So I guess we have to somehow, I don't know how we would know this, but somehow we would have to determine that the truck that we leased to somebody else, if they used it in 3 different states, we would have to find out how many days they use it in state 1, how many days they use it in state 2, how many days in state 3, and allocate it out that way. Part D, what if the rental payment is computed based upon the number of miles driven? So let's say, so instead you're sort of like Avis and you're saying, all right, you're going to pay a rent to me based upon the miles that are driven. So section 5 literally says nothing about this except, again, the comments. Go to the comments. Comments in section 5 allows for alternative measurement pursuant to the actual deal, the actual contract between the parties. So I think in that instance, you could allocate based upon miles in each state rather than the days in each state, right? They're giving you the authority to go and look at the deal and come up with something that's closer to the deal. Section E. What if taxpayer hasn't got a clue where the lessee is using the property? So you're like the rent-a-car company. You have no idea where people are taking those cars. Well, actually, that would be business income, wouldn't it? So that's a bad example. So you're in a non-business situation. You allocate and you rent tangible property, but you have no idea where people are using the tangible property. Look at the last sentence of section 5C. It allocates income this is weird, to the state where the lessee first took possession of the property. So, and I guess you would have to know that, right? If you own property, you had to give it to him someplace. So if you gave it to him in Ohio, and then you have no idea what he did with the property after that, then you would allocate. Your best information, I guess, is that the property was used in Ohio and therefore allocated all to Ohio. Okay? With me? All right, I haven't seen a comment in a while. Have you all walked away and are watching Netflix right now? I'm gonna have to assume yes, but I'll keep talking. So, all right, my objective is to finish the next section, which is royalty income, which would take us, that would take us to question 45. That seems ambitious. What time is it now? It's 5 to 9. All right. I'll tell you what. Here's the deal. Next class, we're going to go from question 37. And the questions really get easier. The apportionment stuff is fairly easy. And what do we go to? We go all the way to, I think, to 75 or so. 76. What do you think? Should we close it down now? Put it to a vote?
Yes.
Okay.
Yes.
Yes.
Okay. We got, do I have unanimous consent on this point?
Yes.
Yes.
All right. Okay. Well, actually, I should base this on a question. We are in great shape right now. If our final, let's see, wait, what says it? We have 2 more classes in April, right? And then I think what, no, wait, do we have 2 more in April? If today is,
Yes.
anybody? Yes. Okay. So we have 2 more in April. And then I think what, we have 4 more. No, we have
Oh,
3 more in May. Well, 4 more in May.
let me see. Two, and then the final. That's my, does any,
That's your interpretation, yeah, because
No,
I'm not
there's-
actually sure when the final is.
the final, it was scheduled originally for May 21st.
So that would give us
And you
2
want to
classes. Yeah, because we lost a class along the way.
And you do want to do a review.
Not necessarily,
Yes.
but I do want to cover some of sales taxes in chapter. All right, so here's the deal. So next week we'll go longer, okay? So we're going to finish chapter 7 next week, and then maybe cover like a little bit of sales taxes, and then that gives me two full classes to get through sales tax, which I've done before. So I've been thrown off schedule here because of we lost a class along the way because of the way they canceled school, right? The week before the midterm. Was it the week before? No, it was the week after the, I forget, I don't know. So
The week of the midterm.
the week of the midterm. Well, we missed a class somewhere along the way. That's why I'm sort of a little out of kilter here, but that's okay. I'm tired of talking. All right, so I'll see you guys. So for next week, no additional reading. We're gonna finish 7. All right, look on Saturday. Maybe we'll read 10 pages or so of chapter 8. Okay, so we'll make it a light week. All right. So, and by the way, I received a whole bunch of papers from people the last couple of days, so I will start looking at them. And that's it. Have a great night. Stay safe, and see you soon. Oh, should I talk about the grading again? Does anybody want to talk about, because we spent,
Sure.
just because we missed, some of you might not have been around on the last class. Did you want to talk about that?
Yes. Okay.
All right. So I know you know all about the grading, but so here it is. You can hang up if you heard this already. But so two things to note. They've really liberalized the grading scale for this semester. Okay, the COVID semester. Oh, not only for this semester, but for the summer semester as well. So, and I forget the percentages, but the A group is going to be huge. And like, I don't want to mislead, but it was whatever I said it was like it was like I forget it was like 40% of 40% of the grades, or I'm forgetting now, but it was a fairly high percentage of A's, and then they wanted like 85% of the grades at B or above. So, and then of course, B minus is as far as I'm concerned, the rest could be B minuses. But anyway, and that's why I'm assigning this extra, for people just to, that was the whole point of this extra assignment, was to get everybody to where, that minimum. Now, somebody can get a B minus or get a B, and they're not happy with that grade. So they're in luck, because this semester you can elect, after you get your grades, you can elect to go pass fail instead. So, and that's it. It's just treated as a pass without being part of your grade point average. So so forgive me if you've heard this all already. So I wouldn't, this is the semester, and I think I'm glad the school has done this for this semester, because I can understand how you could not, this is not high on your list of priorities right now. So, but I'm glad I'm glad almost all of you come to class and listen to me, and it's fun, and it's fun for me. I don't know if it's fun for you, but I'm enjoying it, and I think you guys would enjoy it and learn more if you're not, getting petrified about grades and all that. So anyway, that's the story. See you next week. All right, I'm gonna say goodbye. Bye.